On the evidence of broad indices, markets were reasonably calm in the third quarter. The UK index provided a small loss of -0.2%, whereas the MSCI World Index of developed markets returned 5%, continuing its outperformance of late. Emerging markets were down -1.1%, while bond markets were mixed, with the gilt market down close to 2% over the period. Credit outperformed, with high-yield bonds returning over 3% in sterling terms over the quarter. These broad indices hit a number of undercurrents which reveal a wide divergence of returns and some developments to worry about as investors. Returns in equities were again dominated by the US, which was up 7.6% in the quarter, while the rest of the world was essentially flat. And within equities, growth stocks materially outperformed other style factors, especially value, continuing a trend that has persisted for most of the post-crisis period. And this has led to what we believe to be stretched valuations across many growth stocks. Over the last 3 months, the market environment has been challenging. Both UK equities and UK bonds declined over the quarter, and there were not many asset classes with solid positive returns. The exception is the US equity market, which was driven by strong performance of technology stocks, the so-called FANGs. Given this market backdrop, our focus funds return for the quarter ranges between -0.9% and -0.6%. The funds with the greatest weight to fixed income markets, generally the lower risk portfolios, suffered on the back of rising interest rates, which served to push down prices of fixed income assets. The portfolios performed better, with returns of the quarter ranging between 0.2% for the lower risk and 1.8% for the higher risk advisor solution portfolios. The main difference between returns was the larger allocation to global equity in the portfolios, as well as manager selection within the emerging market equity part of the portfolio, and they aided returns overall over the period. Despite more challenging performance in the recent period, looking at the longer time horizons, the portfolios and the funds are still very much on track to deliver their investment objectives. Our equity allocation is broadly in line with the strategic asset allocation. Within equities, we have an overweight allocation to emerging markets, and we're aware of the additional risk when it comes to emerging markets, and so we monitor the macro situation very closely. However, today, from a valuation perspective, emerging market equities are the cheapest asset class available to us, and so it warrants having a slightly larger allocation. In fixed income, over the last 12 months, we've been increasing the allocation to government bonds, particularly in the US, where rates have increased substantially. And more recently, we've reduced the allocation to inflation-linked bonds, as higher inflation expectations are now priced in and linkers are quite expensive. We've also been reducing the exposure to corporate bonds as credit spreads tightened and investors are no longer adequately compensated for the additional risk. For the credit exposure we do hold, we mainly hold short maturity bonds as they have better risk-adjusted returns due to the lower return impact caused by rising interest rates. We also see some value in emerging market debt, and as a result we have a small allocation there. As the opportunity set in traditional asset classes, particularly bonds and cash rates, remain limited, we have part of the portfolio invested in liquid alternative funds, a basket of funds that have little or no correlation to equities and bonds, but can still deliver returns in the high single digits. Although the global economy generally is in good shape, with reasonable growth combined with low inflation, it's not a time for investor complacency. Some of the negative developments in recent weeks, such as the EU's problems regarding Italy and Brexit, could be of a relatively short-term nature, but it's becoming increasingly likely that the trade war between the US and China will persist for some time and could have a rising impact on confidence and growth. Most importantly of all, the US Federal Reserve will continue to tighten policy by increasing rates, probably to over 3% by the end of 2019, and also by removing liquidity through other means. Bond yields could well rise further, putting pressure on other asset values, and those countries, companies and households with excessive debt face difficult times ahead, and much greater caution is warranted with respect to credit risks in portfolios. It will be important to watch for signs of any pickup of inflation in the US, notably in wages, as this would be a potential trigger for an unexpectedly sharp tightening of monetary policy. However, there are few signs currently of excess or capacity shortages which might trigger an inflationary surge, and perversely, the factors which are worrying investors could provide the brake which constrains growth and inflation to sustainable levels for some time ahead. There are good reasons to expect a period of bumpiness in markets, but the cycle has further to run. With monetary policy set to tighten further, this remains an environment to keep duration short and progressively move away from credit into government bonds. Greater resilience is warranted in portfolios, and there are ample reasons for a more cautious approach, but there are still attractive investments across many equity markets, and the inevitable setbacks will present opportunities to add to positions selectively.